Hi, this is Michael Joyce with JoycePayne Partners, and I'm pleased to share with you our thoughts and viewpoints for the spring of 2018. And what a wild roller coaster of a ride we've had so far this year. In January, we looked at a lot of our clients' portfolios after 3 weeks of the year, and we said, if we keep this up for the next 49 weeks, we're going to be up 50 or 60% for the year. But alas, we could not keep up that momentum. And in February, we had the long anticipated correction in the markets, which, it was steep enough. It was about 12%, but it was really pretty short-lived. And what caused it was actually some really good news about the economy. As we've talked about before, the job market is very tight. The unemployment rate is low right now. And what came out in the January jobs report was that there were real wage increases, which is a good thing. We want people that are in the workforce to be making wages that's higher than the rate of inflation. But it spooked the investment markets a little bit. And the reason it did was many people in the investment markets thought that this could be the start of higher inflation. And if we have higher inflation, that's going to mean there's going to be higher interest rates. And if we have higher interest rates, that's not going to be a good thing for stocks. It's not going to be a good thing for long-term bonds. And it's not going to be a good thing for real estate. And investors are not wrong to be worried about that. The labor markets are pretty tight. And, if interest rates do go up and are sustainable at those levels, that wouldn't be a good thing. But you should also take into account that there are some, in our opinion, powerful secular disinflationary forces that are out there. One is the globalization of supply chains. Another is the role of information technology in pricing. Think of the Amazon effect. How many of us go into stores and pull out our phone and say, I wonder what this costs on Amazon or comparison shop online. And a third factor, which is really a very big factor, is the role of demographics. We have an aging society in the United States, and it's worse in Western Europe and Japan. The emerging markets are certainly younger, but one of the big components of economic growth is you have to have population growth. So the fact that we have baby boomers who are retiring every day, that's going to play a role also in keeping a lid on inflation and also keeping interest rates a little bit lower. So for the past quarter, bond investors haven't fared quite as well. When interest rates go up, bond prices come down. So interest rates have gone up since the beginning of the year. So most bond investors have had negative returns year to date. Although I would hasten to add that our clients have had positive returns for the year because we have focused for a long time in short-term bonds. And short-term bonds have less interest rate sensitivity than longer-term bonds. So what we also had over the past month or so has been worries about trade and trade wars and tariffs and things like that. And that's also caused some of the roller coaster effect. And as we're often reminded, nothing has actually been implemented yet, but just some of the impact of some of the potential problems with protectionism have already had some impact on the economy. So that's something that we're keeping a careful eye on. But overall, we're still in a position that we don't think that there's going to be a recession anytime soon. We think the economy is going to continue to expand, and not just the United States economy, but global economies. And as that occurs, earnings will continue to go up. They're just not as cheap as they used to be. The U.S. stock market is trading at about 16.5 times forward earnings. It was at 18 times earnings around the beginning of the year. And if we look at the developed markets, the emerging markets, they're trading right about their historical levels. So things aren't expensive, but they're not quite cheap right now. So we're still in an environment that, if there's things that rise a lot in price, have gotten a little bit ahead of their fundamentals, we're going to prune those positions. There's plenty of things even this year that have gone up a lot. A stock like Netflix is up 70% for the year. So those are some things, to look at. And also there's some things that are getting to be pretty decent valuations that we should look at. But overall, our mantra is be careful, to stay the course, but keep an eye on all the other factors that could impact the investment markets. This is also a pretty good time of year to look at some other parts of your financial life. I think everybody knows that there was a major tax bill that was passed right before the beginning of the year, and that's going to impact nearly everybody's tax returns. And despite the loss of plenty of itemized deductions or limitations, what we have found when we've looked at our clients' tax returns and how they might be impacted by the new tax law, we have found for the most part that our clients are going to fare a little bit better. And the main reason is because tax brackets have been reduced and the brackets themselves have been elongated. So it is a good idea, now that we're past the tax filing date, except for people that have filed extensions, to sit down with your financial strategist at JoycePayne Partners and review your tax returns and look at them to see how the new tax law is going to impact you for this year and what steps you can take to optimize your position from a tax standpoint. It's also a good time to pull out your estate documents and to look at your beneficiary designations and review those at this time. One of the provisions of the new tax law was that the federal estate tax exemption was expanded to $11 million per person. So a couple, would have a total amount of $22 million of assets that could be exempt from federal estate taxes. So very few people are actually going to be subject to federal estate tax, at least for the foreseeable future. But what you really want to do is take a look at those estate documents, take a look at the beneficiary designations, and make sure that the people that you want to serve in there, like as an executors or trustees, are the people that you still want to have in those places, because it may have been quite a while since these have been reviewed. And to make sure that these documents and beneficiary designations and account titling are done in a way that you want your estate to eventually pass on. So again, this is a great time to get together with your financial strategist at JoycePayne Partners to review your estate planning as well. The time is almost here. We've been talking about our brand refresh for JoycePayne Partners, and stay tuned because it is coming up very shortly. As my 15-year-old son would say, our brand refresh is going to be dope. We are very excited about it, and we hope you all are too. We're also going to have some events around our 25th anniversary of the firm, which is this year as well. So stay tuned. I've been very pleased to share with you our viewpoints for the spring of 2018. If you want to find out more about us or find out more about what we're thinking, visit us at JoycePaynePartners.com or visit us on Twitter at JoycePaynePTRS. Thanks a lot and have a great day.